Good morning. This is Japanese Economic Review Channel. Welcome to today's market recap for Friday, August 7th, 2026. Yesterday, Thursday, August 6th, we witnessed a profound divergence in global markets. Value stocks rallied on easing geopolitical tensions, while a sharp correction hit tech and semiconductor shares. While our value index gained 12.4% year-to-date, showing market resilience with a score of 88, tech fell 4.7% this quarter, and semiconductors dipped 8.1% this month. Let's examine the underlying forces behind this split. Looking at yesterday's close, the divergence is striking. The Nikkei 225 fell 617 points to end at 65,683, while the Topix rose 9 points to 4,055, marking its third consecutive gain. This mirror image was triggered by Wednesday's action on Wall Street, where the Dow Jones gained 263 points to hit a record close of 54,349, while the tech-heavy Nasdaq slipped 221 points, breaking its 5-day winning streak. Let's explore the geopolitical catalyst for this rotation. The primary driver of Wall Street's divergence on Wednesday, August 5th, was a significant geopolitical shift. Easing inflation fears powered the Dow Jones to its third consecutive record high. Meanwhile, a heavyweight tech sell-off dragged the Nasdaq down for the first time in 5 days. Major tech names, including SpaceX, AMD, and SanDisk, faced heavy profit-taking, which immediately set a cautious tone for Tokyo's semiconductor sector on Thursday morning. Wednesday's market rotation began with major geopolitical progress. The US, Iran, and Oman approached a trilateral interim agreement to normalize transit through the Strait of Hormuz. This breakthrough drove NY crude oil futures down for 3 consecutive days, relieving global inflation anxiety. As inflation fears eased, capital immediately rotated away from expensive tech and flowed into traditional, stable value equities on Thursday. This global shift created a mirrored divergence in Japan yesterday. As shown in our matrix, Wednesday's US value gains translated into Tokyo's defensive strength, lifting the Topix by 9 points on Thursday. Conversely, Nasdaq's tech weakness triggered a sharp semiconductor liquidation in Tokyo, dragging the Nikkei 225 down by 617 points. This rare decorrelation between Japan's major indices highlights how global sector rotation dictates local asset flows. Intraday action yesterday revealed incredible resilience. The Nikkei opened under heavy selling pressure, bottoming out at 10:46 a.m. at 64,942, down a staggering 1,358 points. However, the afternoon session saw a massive wave of bargain hunting, targeting strong earnings stocks, which narrowed the final loss to 617 points. Trading was exceptionally active, with prime market volume reaching 2.67 billion shares and a historic turnover of 9.68 trillion yen. The 617-point headline drop in the Nikkei masked a highly robust market yesterday. In the prime market, over 70% of equities, 1,130 stocks, actually gained value, while only 401 fell. Similarly, 26 out of 33 industry sectors rose, and only 7 fell. This proves that Thursday's decline was not a broad market panic, but rather a highly concentrated tech and semiconductor sell-off, leaving the rest of the market in a very healthy state. Let's examine the 7 losing sectors that dragged down the Nikkei. Heavyweight tech and export-related stocks bore the brunt of Thursday's sell-off. Major losers included semiconductor giants like Advantest and Tokyo Electron in electrical equipment, Sumco in metal products, Tokyo Seimitsu and Hoya in precision instruments, and Disco and Daikin in machinery. Additionally, non-ferrous metals like Sumitomo Electric and Fujikura saw notable pullbacks. In contrast, 26 sectors rose yesterday as capital rapidly rotated into defensive and domestic demand equities. Pharmaceuticals led the charge, with Astellas Pharma and Daiichi Sankyo gaining ground. Traditional consumer staples also thrived, including food giants Asahi and JT. Textiles like Teijin and Toray, and entertainment leaders Nintendo and Bandai Namco also saw strong inflows as investors sought shelter in companies with solid, stable earnings. The tech pause also impacted emerging markets yesterday. The Growth 250 index fell for the first time in 6 days, mirroring the broader semiconductor consolidation. Tech-adjacent growth names like DataSection, Base, and ACSL faced profit-taking, while the high-profile recent IPO Tier 4 tumbled. However, the decline was well contained, with robust business models like MTG and North Sand bucking the trend to post gains, showing that selective buying remains active. Beyond market noise, Japanese corporations are actively building future capabilities. In enterprise tech, Yamato HD invested in JIJ to deploy quantum computing for logistics. Trusco Nakayama began full operations of its Exotech 3D high-speed picking system in Aichi. Transcosmos relocated its Yokohama HQ to Minato Mirai as an AI development hub, while Rome launched its second-generation terahertz wave device evaluation kits to advance next-gen telecom. In consumer sectors, yesterday brought exciting product announcements. Key Coffee announced an adjustable-strength Café au lait pouch for September. Meiji HD slated a limited edition pear kaju gummy for August 18th. Earth Corp is releasing Sumiko Garashi-themed bath liquids on August 20th. Finally, Fujifilm introduced a high-definition 4K interchangeable lens projector with 120,000 lumens, highlighting continuous Japanese innovation in hardware. To conclude, yesterday's market action offers three key takeaways. First, easing geopolitics in Hormuz catalyzed a powerful rotation into traditional value stocks. Second, the sharp index divergence exposed the Nikkei's high concentration in a few semiconductor heavyweights. Third, underneath the headline drop, Japanese market breadth remains remarkably healthy, supported by 9.68 trillion yen in active bargain hunting. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.